Welcome to Minds on the Markets. We have bad news and we have good news. The bad news is that we can't take each and every student on a field trip to the major financial markets. The good news is that we can now bring those exchanges into the classroom. I'm Steve Kussin, education reporter for WCBS News 880 and professor at Hofstra University. And I also have the privilege of hosting this groundbreaking series, during which we will introduce the pillars of the world of finance to you. I was also a high school principal, so I've heard the questions that students and teachers want answered. Our first guest today is Mr. Robert Greifeld, President and CEO of NASDAQ. Mr. Greifeld, I'd like to thank you for being with us today.
It's my pleasure to have you here.
And talking to our students and our teachers. Before we get started with the questions, I wanted to get some background about you. I did some research. I found out we had something in common. We're both English majors, but we went two different routes. How did you get interested in finance, and how did you get started in this field?
Well, I would say that I have primarily a technology background, and when you look at an exchange today, it really is a technology processing company. So I went to a computer company, then went to grad school for my MBA with a concentration in computer science.
See, there is some hope for English majors too.
There is, no doubt about it.
Okay, a basic question before we get started. What is a stock market, a stock exchange, and what is the role of a stockbroker?
I'm going to step you back. The first question is, how do you determine a price of anything, right? You have a widget, you have a product, you have a company. What is it worth? The best way to determine that is to let the largest number of interested parties come together at one time, all of their different views of what the asset, the company is worth. And in that divergent set of views, you come to a common viewpoint. That's what an exchange does. That's what a market does. Our job is to provide equal and open access to all interested investors. Some want to be buyers, some want to be sellers, some believes the stock should be higher, some believe it should be lower, some are interested in a lot of shares, some want to buy one or two shares. They all come together, and in that discordant environment, you discover price. So the essence of what we do is discover price for the companies that are listed on our market.
What's the role of a stockbroker?
The stockbroker, it facilitates investors coming into the market. So our customers are not the retail investors. Our customers have to be registered broker-dealers, registered stockbrokers. They have certain fiduciary obligations to their customers, and they have requirements that we impose upon them that they have to meet. So they're the intermediary between the market and the real end customer.
You mentioned a few seconds ago widgets. If you and I went into business together and started to manufacture widgets, how would we decide if we wanted to go public or not?
Well, a key thing in terms of going public is the requirement for capital to grow. We see that 92% of job creation happens after a company goes public. That is related to the fact they come public, they raise money. I come public, I sell the concept of my business, I sell equity, so I'm giving them paper which represents interest in the company, and in turn I get cash. I use that cash to invest in the business to have it grow. So when I need the company to grow, and it's funds I need beyond what I have in my own pocket, then going public is a good option.
How do we decide which stock exchange we're going to go to?
Well, that's an easy one. You choose to come to NASDAQ. You saw Facebook chose that, and what we have at NASDAQ is our advantage is that our marketplace was the first electronic marketplace. We have a fair and democratic access to the market, and you see as a result of that, more trading activity, and also the transaction cost in the marketplace is a lot lower. So we've done very well.
What do we need to qualify to be on NASDAQ?
Well, what's interesting, we have different levels of standards. So we have 3 markets, and the criteria for qualification is less. invest in the capital markets, and it steps up as you go to the global market. Then the highest tier is Global Select. So the differences are around how much equity has to be in the company, the revenue size of the company, the period of time you have been profitable in the company.
So it's not automatic. You have to qualify.
Oh,
as
you
say.
definitely have
Absolutely.
to qualify. Yeah, I mean, being public is not for all companies. Clearly, companies who have a growth path in front of them that are solid companies that can meet the disclosure requirements. Understand, when you go public, you're taking in owners that you don't know intimately, and those owners have a right for governance and control over the company, so they know their investment is protected there. So not all companies are ready for that level of oversight and/or rigor.
Let's go back to our widget company.
Right.
So to summarize, how are we going to determine the share price as widget goes on NASDAQ?
Well, you're going to determine how many shares you want outstanding.
Okay, that's
all right. So to the extent I'm a company, I'm making $1 million in earnings, and I'm going to issue 1 million shares, and then my stock will trade at $1 per share. To the extent I'm making $1 million and I issue 10 million shares, then I'll trade at $0.10 per share. Still the same company.
Gotcha, yes.
Still the same company. If I have making $1 million and I issue 100,000 shares, then I'll trade at $10 per share. So the share price is a function of how many shares you issued, divided into your actual earnings. So that $1 million company, whether the stock is $0.10, $1, or $10, doesn't really mean one is a better company than the other. It just means that the board of directors decide to issue, X number of shares.
Let's go back to NASDAQ. You were the first to do online trading.
Yes.
Am I correct?
Yeah.
Any other changes in the last 10, 20 years in the course of the markets? I know the computers played a big role, the internet, right?
How about the last 10 or 20 minutes?
You're right, exactly. I'm looking right behind us, yes.
So in terms of historical perspective, NASDAQ was founded in 1971. In 1971, every single stock market on the planet had a physical trading floor, and they had people who'd come to work on that floor, and they generally would wear a smock, a blue smock, whatever that was the dress code. And the people who came to work on that floor really had certain privileges, privileges of time and place, resulting in informational advantage over the general investor. NASDAQ, in its great wisdom, said that computers and communication technology had evolved to the point that we didn't need a floor. We could hook everybody together through a network. The internet didn't exist back in that day, but they saw it in the early days. And the important part, not so much the technology, is the fact that structure allowed the market to be open and provide democratic access to everybody, fair access to everybody. We didn't have certain people who had all these privileges that floor-based markets had. So we've seen that model become the dominant model on a global basis, and certainly NASDAQ is uniquely proud of its unique heritage in that regard. And what we've seen since that time is our customers become obviously electronically sophisticated. So the old scenes you see in a movie where somebody would say, buy me 1 million
Yes.
shares, or buy, sell.
I remember those.
Yeah, right now that doesn't so much exist. There are algorithms that are set up by our customers which will release orders into the market in the predetermined fashion of that algorithm. So the guy will say, guy or gal will say, I want to buy 1 million shares of Apple, and that will go into the algorithm, and the algorithm will have in it, feeding into it, all the different dynamics of the market, the factors, and based upon that, it will release orders in the fashion it thinks it's wise. And it's a real-time self-learning algorithm that it plays with. So that's been obviously the biggest change, and we on the other side then have to deal with that increasing electronification of our customer base, their sophistication. We have to build really systems that handle more transactions than in a second than any other commercial application. So our systems can do over 1 million transactions a second.
Say that again, 1 million
transactions per per second, and your second's not that long of a period of time. And for an order that comes into us, we can respond in about 50 microseconds. All right, so we went from a second to a millisecond to a microsecond. So it's a high-speed Star Wars type of environment that you live in today.
We're in the recession, trying to dig out of the recession now. What's the relationship, the correlation between the markets and the economic recovery currently underway?
Well, I would say, one, we're not in a recession.
Oh, good. Glad to hear that.
Right. Under technical economic
Good.
definitions, we haven't been in a recession for a while. But you would say this, that the markets over the medium and long term are directly correlated to GDP growth. When the economy is growing, then obviously the citizens are doing well, they have investable assets, they have confidence in the market, and the buying of an equity is really a very high level of expression of confidence in the market. I like to say that the equities are really the first derivative, and they're derivative on the economy. Right, so people do not want to buy equities when they think the economy is going to decline. So we're definitely correlated, whether we are a leading indicator of economic growth or a lagging indicator. I change my mind on that depending on the day, so I don't have a firm opinion.
Our high school students, many of them are interested in investing, others are interested in getting involved in the world of finance. Advice for high school students who are thinking about this as a career or simply just getting involved in the markets. Anything you can say to them?
Sure. Well, one is obviously study hard, in that it is a highly competitive field to enter, and the finance world definitely attracts very motivated people to its world. So it's hard enough to break in. So you want to come at it, with a serious mindset. As you see from my background, which was not traditional finance, within the finance world, it's also technology is a key part of it.
Interesting,
So,
yes. Yes.
So when you look at some of the major banks, they have more technologists than some of the leading technology companies in Silicon Valley, right? Their technology staffs are massive. We have, basically half our employee base comes at it from a technology point of view. So you have your classical field of financial studies. We certainly recommend that as a good path. You have technology larger than you can ever imagine with respect to how it drives the finance industry. And then you have increasingly, you have the mathematical skills to build the algorithms, the ways the markets will function.
Thank you for giving generously of your time, and I want to thank teachers and students for welcoming Minds on the Markets into the classroom. Thank you all.